So now let's move on the next sections about credit differentiation. So we have talked about the market, and we have talked about the sector performance and the key risks that's the company facing. So let's talk about ratings, or credit differentiation, and why rating matters. So I would like to call Kwon and Prachi to share to the audience our rating analytical work for the securities service sector, and the the historical default or proxy of default happen in the market for the understanding of the investor and the meaning of our ratings. So Kwon, please.
Sure, Anton.
So go quick, Kwon. Sorry. So maybe not every details.
Yes,
we overrun a little bit.
Yes, of course. So in this section, we'll cover the credit differentiation of the sector. In this slide here, if you can find on the left-hand side, our distribution of the indicative standalone credit profile. So without any external influence of the 58 active securities brokerage company in Vietnam in 2021, that cover about 99% of the sector figures. Please note that the distribution is purely quantitative based on public information of this company, incorporated with key credit matrix that FinRating used to assess securities company. And this is also note that this is a very condensed distribution without detailed notching level, plus or minus sign. In the detailed distribution, the standalone credit profile of this securities company vary from A to BB minus. The key points we're trying to make here is that while majority of securities company are currently above investment grade level, which is BBB minus and above, which is a good thing. A good portion of those are only a notch or two above the speculative grade, and their credit profile can be severely impacted by major downturn in the market. Since the credit rating is relatively new to the Vietnam market, we also include an explanation of what this letter A or BB or BBB means. What's the difference of the company that has a standalone credit profile in the A category compared to the BBB and BB category? Simply put, a company in the A and above category would be able to withstand a major market downturn event without facing liquidity issues in comparison to BBB categories, because they have a very strong business position with stable earning, solid risk management policy, and strong capital base and funding ability. While companies in BBB category would have an adequate business position and stable earning, but their risk appetite might be somewhat higher, maybe because they're trying to grow, but their risk management is still somewhat solid. Their gearing level might be high, but they also have strong capital base and plan to fund their business. So this company in BBB BBB category would be able to withstand the minor economic fluctuation compared to company in BB category and below. Prachi, is there anything you want to add here?
Yeah, I mean, I can offer a regional perspective here and also kind of give a sense of how this BBB looks compared to, let's say, some other country ratings. And essentially, as Kwon is mentioning, this BBB rating is like our assessment is like a two-layered assessment, and it does factor into the fact that this particular sector is exposed to various risks such as market, operational, regulatory risks, and also the fact that securities companies are inherently volatile and do not have the benefit of accessing diversified forms of funding, unlike a bank, which is why you see that our anchor rating for securities companies is 2 notches lower from our bank anchor rating. And this is in line with what you would see in other countries. Just to give you an example, the S&P Global's securities anchor rating for China is actually in the BB category. And for Japan, US, and UK is in the BBB mostly on the lower side of the triple B category. So these ratings really indicate that there are various forms of risks which can be heightened given the uncertainties of the market movements. Even in India, when you see the ratings for securities companies, they would mostly be in the triple B rating category, that too on the lower side, like triple B minus. So I would say that our assessment is in line with what you see in other global rating agencies, and adequately factors in the risks that these companies and the industry face.
Thank you, Prachi. So how about the rating and pricing, Kwon and Prachi?
So if you go to the next slide here, regarding rating and pricings, we perform a a simulated comparison between the 10 securities company. We can call it sample size, standalone credit ratings, and they recently issued 24-month bond coupon rates to see if there's any relationship between them. We can easily recognize that here the companies on the left, the issue on the left hand side, the five one on the left hand side who have rate who are 1 or 2 notch above anchor from triple B plus, A minus or A, are currently issuing at 7.3 to 8.1%, with the exception of one company. And the companies on the right, majority of them who are 1 or 2 notch below the sector anchor, so triple B, BBB minus and BB plus, are currently issuing at 9 to 10%, with the exception of one as well. So the inconsistency or the outlier, in our opinion, because the rating is only standalone profile, so it doesn't take into account the full external influence, and also because there is a current mismatch between the coupon rates and the issuer credit risk profile. So based on that, we can conclude that there is certain correlation between our rating score and the issuer coupon rates. Thank you.
Thank you, Kwon. And for the information, everyone. So we are the rating agency. We don't do the pricing because we have been requested by some of the investor. Hey, what should be the reasonable pricing or interest rate for this bond in order for them to buy or to negotiate? So the answer is we are not the pricing agency, and we are not giving the advices or recommendation on the pricing, but we do share our rating scale and historical default for the investor doing their pricing references. And of course, it depends on the terms and condition that they are discussing with the issuer. Here is a local securities company as well. And we do provide the mapping or some reconciling between our domestic rating scale and its international scale, especially for the offshore investor, for their understanding and using one of the input for their pricing. So it's a process going on, and we as long as we have more rating universe and historical data on default, so we believe we can support you better in the years to come. And next, so why rating matter? So Kwon and Prachi, you want to quickly mention this very complicated slide?
Sure, Anton. When we look at the we do look at the sector historical default in the last decade. Many companies, many securities companies are established in the 2000s, but it's not until the early 2010s when there are a lot of companies established, as the barrier of entry for the sector was quite low back then. Our analytical team at FinRating did a kind of looking back study in this sector, and since 2010, there has been over 20 cases where companies went into default in our definition, with the most recent case in 2020, which is not that long ago. In our opinion, this is why credit rating matters, because while there are few cases of voluntary dissolution, majority of cases are caused by companies being financially distressed, and that would require termination, restructure, or regulatory intervention. And these cases are only recognized when it was too late. A lot of the audience here are creditors and investor of the securities company, and it's important to I think it's important to monitor the credit profile of the companies, because not only the first time monitor the first time we rate, but also we do surveillance and we monitor the credit profile of the companies over the period of time. So that's why credit ratings matter. Prachi, anything you want to add?
No, I think we can go ahead. Just a point that I'd like to mention here is that this is the reason why we don't look at only the recent financials of a company. We do go back in time and see how the company has been able to manage up cycles and down cycles, because there could be companies which can go very aggressive when the market is going high and therefore can get into problems, or there could be companies which in a market downturn are not able to manage their costs and therefore can go under. So that's the kind of detailed assessment that we would be doing by really going back in history and seeing the ability of the management as well as the overall performance of the company throughout cycles. Yeah.
Thank you, Prachi. We got a lot of questions especially from the Vietnamese retail investor asking why ratings are important. I said, well, you are having a fixed income over the next 5 or 10 years. So you don't have any upside potential, right? So like the equity investor. So what would you care for? So it's about the possibility the issuer or the company failed to pay your interest and the principal, and the default or a similar net event like this is very important. So our rating is to track the forward-looking and that's kind of possibility from our rating scale and outlook and the credit watch and so on, and that's our profession. So it's quite new for Vietnam, and the audience we are educating the market as well.